I just wanted to take about 10 to 15 minutes to walk you through some of the key findings of our newest report on Chinese investment in U.S. high-tech sectors. So we've got a common foundation for the discussion later on. If my slides work, perfect. All right, so as Bruce has mentioned, this report is our third collaboration, and as with the previous two reports, the foundation of our work on Chinese inbound investment to the United States is a unique database that allows us to fairly accurately describe what's actually happening year to year with Chinese investments. We have a database in which we track both greenfield investments, so new projects like factories, offices, R&D laboratories, and acquisitions by Chinese-owned companies in the United States. And this is what the inflection looks like that we actually came up with, which is very different from what the official numbers, both on the Chinese and the US side, show. As you can see, there's very little happening before 2008, 2009. There was a first inflection in 2009, 2010, which is when we came out with our first report, An American Open Door. And then over the past 3 or 4 years, we really have a massive growth in the total investment coming in from China to $14 billion US dollars last year alone. Now, most of that increase over the past 2 to 3 years has been driven by big ticket deals in sectors like energy, real estate, utilities, last year food and agriculture. But a second very interesting trend that we saw when we looked at each individual deal is that Chinese investors seem to be more and more interested in innovation and technology-related assets in the US. And that's how this report here was born, the idea to do a primer on Chinese investment in US high-tech sectors. The first challenge we had is how do you define high-tech? There's no really commonly accepted definition of what a high-tech industry is. So what we did is we took an industry-by-industry approach and followed what the OECD is doing by picking 15 industries that would be considered advanced manufacturing and innovation-intensive services. It's a little broader than what a typical Silicon Valley venture capitalist would consider technology. We were just there yesterday, and some of them were like, that's a little too broad for our perspective. But I think if you want to look at the national picture, that's an appropriate approach to take. And here's what the patterns look like. As you can see, there was almost nothing happening really before 2009, 2010, except in 2005, which was the one big Lenovo IBM personal computer transaction. Ever since 2010, so in the years 2010, 11, 12, and 13, we see an increase of the average annual deal flow coming in to about $1.5 to $2 billion every year. But as you can see, the increase is not as fast as the growth of overall Chinese FDI. However, that's changing rapidly, and if you look at the 2014 bar, in the first quarter alone of this year, we already have deals pending, announced and not completed, that are worth more than $6 billion US dollars. The two big ones are the sale of IBM's low-end server business to Lenovo and Google's spin-off of Motorola Mobility to similarly Lenovo. We've got Fisker, automotive, and a couple of deals in the medical devices sector. So really not much activity before 2010, a structural increase to $1 and $2 billion between 2010 and 2013, and then 2014 looks to be a really big year for Chinese investment in US high-tech. Looking at it industry by industry, we see an interesting evolution from just a handful of manufacturing industries in the early years, like IT equipment, electronics, automotive, and machinery, to a much more diverse base of interest on the Chinese side. For example, So we see new manufacturing industries getting a lot of interest, like renewable energy, aerospace, medical devices, already mentioned. And one of the most interesting trends is that we see a lot of activity in knowledge-intensive services, like software and IT, and in recent 1 or 2 years, even pharma and biotech. So another reason to be optimistic about deal flow in coming years is that the base is broadening, and private sector companies in these industries are increasingly confident and capable of doing deals in the United States. This is what the distribution of high-tech FDI from China looks like state by state. And one of the reasons we're doing these events here in California is it's not only because the Asia Society is paying for it, but it's also because California is the single most important recipient of Chinese high-tech investments by numbers. Almost 150 deals out of about 500 deals in total that we track are going into California. Other economies that are, other states that are getting significant levels of Chinese investments are North Carolina, New York, or states with interesting clusters, like Michigan, Ohio for automotive, Texas for energy-related technology. But California is really the hotspot for Chinese tech investment. Zooming in a little bit, and I'm sure we can talk about some of the more local developments, local perspectives later on the panel. That's what it looks like for California. Couple interesting things. First, I think the inflection, the growth happens a little earlier than on the national level. Already quite a bit of activity in 2006, 7, and 8. If you look at it by industry, not surprisingly, software and IT, electronics and semiconductors are the really big areas. But as with the national picture, in the past 12 to 18 months, we see a lot of activity in other sectors like renewable energy, like pharma and biotech and medical devices. Now, one important thing that we try to do with the study as well is clarify the commercial motives that are incentivizing Chinese firms to come here. There is unfortunately still this misperception out there that Chinese investment is all about the Chinese government telling companies to go out and buy strategic assets that are good for China. We are, since the first report, we're trying to educate people that that's very far from truth in most sectors, at least. And so what we try to do here is we try to look at each of the 500 plus deals and coded them by commercial firm level drivers for FDI. There's 5 different categories that are usually used in economic literature to describe firm level FDI drivers. And the 3 most important findings from this analysis are that there's a market-seeking FDI, so Chinese companies are coming here to build or defend their market share. A good example is BYD. You can't sell your buses here if you don't have maintenance and local operations. Second important driver that has gone up quite a bit, this is the red bars, strategic asset seeking, meaning Chinese companies trying to buy brands, technology, patents, know-how, and existing staff base. And a third important motive is what we have in blue here, efficiency seeking. That means that Chinese companies have begun to think about value chains from a global perspective, and they try to come to the US to utilize local advantages. So a strong legal framework for intellectual property protection, a local talent pool, and local industry clusters that they can find nowhere else in the world than in Silicon Valley, for example. After clarifying the trends and the drivers, one other important part of the study is to get a first idea of what the impacts are on the US economy, on US workers, on US consumers. And historically speaking, FDI was always a very strong net positive for US innovative capacity. And one example that people always cite is the case of Japan. As levels of FDI from Japan increased over the past 2 or 3 decades, with it came job creation, local R&D investment, a greater compliance of Japan with intellectual property rights protection and other globally accepted norms, which was by and large a very positive thing for the US. And other economies like South Korea, Taiwan, a very similar trajectory. So people are out there and see that the world's second largest economy is getting ready to take that exact path and are getting excited, of course, about the potential benefits. But then you have the other perspective where pessimists are saying China is a very, very different case. They have a very different political system. China's economy still has a lot of non-market elements, a lot of state capitalist elements, what they call. And yeah, who's going to tell us that they're not just going to come here, buy technology, and then take that stuff and the higher value added activity around it back to China? And so what we try to do is take our data set and look at these deals to find some preliminary evidence for which direction some of these things are taken. We got some very interesting preliminary findings. Again, those are some initial findings. The track record is generally not long enough to come to a definitive conclusion. But one of the interesting things that we find, for example, is that Chinese investment in these 15 high-tech sectors already today employ more than 25,000 people in the US. 5,000 of these jobs have been newly created through greenfield investments by ZTE, Huawei, and others in local R&D operations, for example. And about 20,000 jobs have been acquired by Chinese companies. And a single most important finding, I think, from the jobs analysis is that we cannot find any evidence, any cases where Chinese companies would have bought a US technology company and then shut down the local operation and moved some of the activity back to China. It's actually quite the opposite. Acquiring operations in the US, most Chinese companies have not only maintained the staff count, but increased it further afterwards, because that's exactly why they're coming here. Access to human talent, access to a diverse and well-educated workforce. So I think that's a pretty powerful finding. And some of the official data that we have confirms that direction. These are numbers taken by the BEA, the Commerce Department. They show R&D spending by foreign-owned US affiliates. And as you can see, the spending of Chinese-owned companies in the US on research and development has grown from 0 in 2007 to more than 350 million every year today. Well, not today, 2011. It's government data, so it's 2 years time lag. But yeah, it's quite significant upward inflection, and I think there's a lot more R&D investment to come. So bottom line, all preliminary data points that we can find point towards a very positive direction, and we hope that this is going to somewhat influence the debate out there about the impacts of these investments. Now, while all this looks fairly positive, there are still significant stumbling blocks that could really negatively influence future investment flows between China and the US in high-tech sectors. And we identified 3 areas that are most relevant for us when it comes to US-China investment relations in tech. The first one is national security screening. This is a topic that is not getting a whole lot of attention in California down here, but it's one of the hottest topics in DC and on the East Coast. National security screening by the Committee on Foreign Investment in the US, CFIUS, has become a major factor in inbound Chinese investment. And as investment is shifting from low-end primary sectors to high-tech, national security screening is going to be an even more important determinant for success in the future. So it's critical that the US really maintains its narrow and transparent approach to national security screening. And it's similarly important that China, which has a similar body now since about 2 years, it hasn't really been applied because there was no need for China to have such an instrument because they still have an approval system for FDI. But that China follows through with a very transparent and non-discriminatory approach as well. In addition to national security, the second emerging threat to open and beneficial U.S.-China investment flows is our existing features of the Chinese economic system that are different than what Chinese companies encounter here in the US. Most importantly, an asymmetry in openness to FDI. So China, despite being very open to FDI since the mid-1980s, China still has one of the most restrictive FDI regimes, and it restricts foreign investment in many, many sectors. That wasn't too much of an issue in the past, but two things have happened that make these asymmetries more relevant than in the past. First, last year, for the first time, Chinese investment coming into the US for the first time surpassed investment flows in the other way around. So Chinese investment in the US is now bigger than investment by US companies in China for the first time. So it's quite a sea change in flows. And then secondly, what we talked about is that a lot more investment is going into industries like financial services, high-tech, that are heavily restricted for foreign companies in China. And so this existing asymmetry has already caused quite a bit of political resistance in the US and in other countries, Australia, Canada. They all have imposed additional screening mechanisms for some of these economic concerns. And so if China does not move fast enough on reforming these things, there is a threat that this could lead to a further politicization of Chinese investment into the US. And then finally, and it's going to be my last slide, the third major impediment or threat that we identify is a lack of confidence on both sides in an open market-based innovation approach. So a lot of the fears that we have here in the US towards Chinese investment is from the belief that it's going to ruin long-term US competitiveness. So our response is we're not going to fix long-term competitiveness by imposing additional barriers to Chinese or other foreign investment. What we've got to do is we've got to implement structural reforms that are going to make sure that the US is the #1 place to go for some of these high-end innovation activities, education reforms, healthcare reforms, immigration reforms. And the same is true for China. China also has to be confident about its share of the pie, that it's not a zero-sum game. So China similarly needs to implement a lot of structural reforms, a better legal system for intellectual property protection, a better financial system that supports innovation. And so I think both countries really have to make sure that they do their homework in order to be confident about letting investment flows in through the border. Taking these three broad areas, we then come up with a number of more narrow policy recommendations for both the United States and China. I'm not going to go over them in detail. I'm just going to leave them up here on the screen for discussion, and I think we're going to discuss them in detail on the second panel that's going to follow. And I'm going to thank you for your attention, and I'm going to pass it back to Jonathan. Thank you.